Imagine pouring your heart and soul into a nonprofit, doing really incredible work, securing grant money to, you know, uplift communities or train professionals. You genuinely believe you're operating outside the commercial world, purely focused on the mission. Then, bam, out of the glue, a tax authority slams you with a massive VAT bill. We're talking tens of thousands in VAT taxes, plus fines, and they refuse your deduction requests. It's like you try to do good and the system hits you with a penalty. What on earth happened there?
That's pretty much a nightmare scenario for any nonprofit director, isn't it?
Yeah.
And it perfectly illustrates a critical and often really misunderstood intersection between, well, good intentions and the very complex world of tax law.
It truly does. Welcome, everyone, to the deep dive. Today, we're peeling back the layers of a really pivotal ruling from the European Court of Justice, the ECJ. And look, this isn't just about obscure tax rules. It's about understanding precisely where that line is drawn between doing good and being considered an economic activity in the eyes of the law, especially when European Union grants are involved. And just to clarify for you listening, an economic activity for VAT purposes, it isn't solely about making a profit. It's more about engaging in regular, sort of business-like transactions for payment. If you do that, the law often considers you a taxable person, meaning, well, you're part of the VAT system.
Right. And what's particularly insightful here is that this judgment, it was delivered on July 4, 2024,
Right.
and it stems from a Latvian case, C-8723. It provides some frankly surprising clarity that will impact nonprofit organizations, public funding recipients, and really anyone navigating that world where social benefit meets financial structures.
So our mission today is to unpack this judgment in a way that really illuminates its practical implications. You'll walk away understanding the nuances that can have truly significant financial consequences for nonprofits. At its heart, this deep dive asks, can a nonprofit association doing socially beneficial projects with substantial public funding be deemed a taxable person liable for VAT, even if it doesn't aim to make a profit and subcontracts most of its services? The ECJ's answer, as we'll see, might just reshape how many organizations view their finances. Okay, let's dig in. So, picture this. Our story begins in Latvia. There's this organization called the Biedrība Latvijas Informācijas un Komunikācijas Tehnoloģijas Asociacija. Bit of a mouthful, so we'll just call it the Latvian ICT Association. This is a nonprofit association set up under Latvian law specifically to pursue nonprofit objectives. But, and this is a key detail, Latvian law does allow these associations to engage in what are called ancillary economic activities.
Yeah, that ancillary allowance is a crucial detail. A lot of nonprofits assume their legal status automatically, insulates them from commercial regulations. But as this case really vividly demonstrates, it's rarely that straightforward. So the association undertook two pretty significant training projects.
Right. The first was an ICT project focused on training information and communication technology professionals. The second, called the MSE project, was designed to train micro and small enterprises. Both of these were major initiatives, fully or partially financed by the European Regional Development Fund, or ERDF, and the funds were channeled through Latvia's Central Finance and Contracting Agency, the CFLA.
Okay, and these kinds of EU-funded projects are incredibly common across Europe, right? They aim to boost local economies, enhance skills, support various social goals. So the way these specific projects were structured, particularly how the money moved around, is absolutely central to understanding the ECJ's decision.
It really is all in the details. Let's get into the nitty-gritty of the funding flows, because this is where it gets interesting. For the ICT project, the association actually charged the training recipients the full cost plus VAT, and in some cases, they also charge management fees on top. Then, the association subcontracted the actual training delivery to other providers. They paid those subcontractors, including their VAT, and then declared that VAT as input tax, just like any commercial business would do.
Ah, but here's the twist. After the association got the ERDF grant via the CFLA, it transferred a big chunk of that grant, often between, say, 30 and 70% of the project costs, back to the training recipients, which effectively subsidized and reduced the recipient's final out-of-pocket cost.
Interesting.
Yeah, and the association also invoiced management costs, usually around 5% or 10% of the aid they received.
And for the MSE project, the structure was a little different but still complex. The association paid the subcontractors the full cost, including VAT. But this project involved a tripartite contract: the association, the subcontractor, and the recipient. Here, the recipient co-financed 30% of the total payment, while the other 70% was covered by ERDF funds through the CFLA. Again, the association was a central player managing all these payments and the VAT handling. So they were very much positioned as the sort of middleman in these financial transactions.
Right, and this complex web of transactions naturally raised a fundamental question for the Latvian state tax authority, the valsts iemu dienests. The question being, who was truly supplying the service here and who's ultimately responsible for the VAT?
Yeah.
After an audit, well, they came down pretty hard on the association.
They certainly did. In 2019 and 2021, the tax authority issued decisions demanding a staggering EUR 87,299.37 in VAT, plus fines and late payment penalties for activities back in 2018. And on top of that, they refused refund requests from the association totaling over EUR 101,000 for 2018 and 2019. I mean, EUR 87,000 in back taxes plus fines for a nonprofit. That's not just a bad day, that's potentially mission ending.
Absolutely. Their core argument was essentially that these projects, by their very nature, could only be carried out by a nonprofit or maybe a public authority, not by what they termed an economic operator.
Right.
So since the association lacked a profit-making objective and didn't directly provide the training itself, the tax authority concluded its activities weren't economic,
Yeah.
and therefore it couldn't deduct input VAT. Simple as that, in their view.
But the association, well, understandably didn't agree. Their defense was basically that their nonprofit status was beside the point. They were registered for VAT, and they argued they acted as an intermediary, which should absolutely entitle them to deduct input VAT. This was a classic clash of interpretations, really.
And this profound disagreement couldn't be resolved locally. The case initially went to the District Administrative Court in Latvia, which, interestingly enough, sided with the association.
Oh, well.
But the tax authority appealed to the Regional Administrative Court. And because of the inherent uncertainty about how EU-wide VAT rules apply in these unique nonprofit contexts, that court decided to seek a preliminary ruling from the ECJ. And that's why this case is so significant, not just for Latvia, but potentially for every nonprofit operating across the EU.
So with our nonprofit caught between, good intentions and a tax bill from hell, with the whole financial structure of their public projects hanging in the balance, the stage was set. How did Europe's highest court untangle this knot? Let's peel back the layers of the EU's foundational VAT law to see what guiding principles were at play. The bedrock for how VAT works across the European Union is Council Directive 2006/111/EC, commonly known as the EU VAT Directive.
Indeed. And the Latvian Regional Administrative Court, in its request for that preliminary ruling, put three really crucial questions to the ECJ. Questions that get right to the heart of the matter for any organization navigating these waters.
Okay, so the first big question for the ECJ, hitting right at the core of our nonprofit dilemma, was basically this. Does a nonprofit running publicly funded projects under Article 9 of the VAT Directive actually qualify as a taxable person doing an economic activity for VAT? This directly challenges that idea that a nonprofit's charitable status just automatically exempts it.
Right. The second question then delves into the role of intermediaries and subcontractors. It asks, if an association doesn't directly provide the training services, but instead acquires them from subcontractors for a publicly funded project, can it still be considered a supplier of services for VAT purposes? This gets at whether the association's intermediary role still makes it responsible for VAT on the services it arranges.
Makes sense. And the third question tackled that complex issue of subsidies in the tax base. If a service provider gets only partial payment from the recipient, with the rest covered by a grant like the ERDF aid, is the taxable amount for calculating VAT the total received from both the recipient and that third-party grant payment? This clarifies how that public funding affects the actual VAT calculation.
Yeah, these questions really highlight the legal gray areas that nonprofits operating with public funds often face. They absolutely had to be answered to give clarity, not just to Latvia, but really all across Europe.
Okay, so with those intricate questions laid out, how did the ECJ respond? Here's where it gets really insightful. The court strategically tackled the questions out of order. It built its reasoning piece by piece, started with the nature of the service itself, then the taxable amount, and finally the status of the organization. It's a very logical step-by-step interpretation. That approach is pretty typical for the ECJ. It ensures a clear and coherent flow of interpretation. So they first addressed that second question. Is what the association doing actually a supply of services for consideration under the VAT Directive?
And their core principle there was quite clear, wasn't it? A supply of services is for consideration if there's a direct link between the service provided and the payment received. Crucially, the payment doesn't have to come directly from the recipient. It can absolutely come from a third party, like a public fund. So if you're a nonprofit and you thought, oh, my charitable status protects me because the money came from a grant, well, this ruling says, nope. If you're organizing a service and getting paid for it, even if the payment comes from a grant and you use subcontractors, the nature of that transaction is what makes you a service provider for VAT, not your nonprofit label. It completely shifts the focus from your legal form to how you operate. Exactly. And what's also fascinating here is the ECJ found it largely irrelevant that the association used subcontractors. The association itself organized, prepared material for, and oversaw the training. From the recipient's point of view, the association was the face of the service. It acted in its own name and on its own behalf when invoicing recipients and paying those subcontractors.
Right.
Think of it maybe like a general contractor on a building project.
Right.
The contractor doesn't lay every brick, but they manage the entire process, hire the specialists, and they're the point of contact for the client. They are providing a management and delivery service.
So there's a particular article in the Directive, Article 28, which deals with taxable persons acting in their own name but on behalf of another. That wasn't applicable here.
Correct. The court said Article 28 wasn't applicable because the association wasn't acting on behalf of someone else in its relationship with the recipients. Instead, you could say the subcontractors were acting on behalf of the association. It's a subtle but legally vital distinction. And just to really hammer this point home, the court stated that even if the income, from recipient fees and the subsidies only covered the costs and didn't generate any profit, this does not prevent the activity from being considered for consideration. The fact that the price might not match market value is also irrelevant. This is crucial because VAT is fundamentally a tax on consumption, not on profit. It's about the transaction, not the bottom line.
Right, that makes sense. So with the nature of the association's activities clarified as a service for consideration, the next logical step for the court was to look at the money itself. Specifically, question 3. When these European grants come in, are they part of the taxable amount for VAT?
And the answer there was a clear, unequivocal yes. The ECJ explicitly ruled that subsidies paid by a European fund for a specific supply of services, like the ERDF funds in this case, are included in the taxable amount. They constitute a payment obtained from a third party that is directly linked to the price of the service. So if you're a nonprofit getting grant money that's directly tied to the price of a service you offer, this ruling says you must consider it part of your taxable amount for VAT. This is a really vital piece of clarity for financial planning and grant structuring.
Okay, so let's circle back to the Latvian tax authority's main argument. Their big point was essentially that a nonprofit, just by its nature, couldn't be an economic operator. How did the ECJ tackle that central piece of reasoning? That was the first big question posed to them, right?
Yes, and this is where the ECJ delivered perhaps its most important clarification in the whole ruling. The court heavily emphasized the objective nature of economic activity. This means the purpose or the results of an activity, like whether you intend to make a profit or actually do make one, are secondary for VAT purposes. What matters is the activity itself, viewed objectively.
And here's where it directly contradicted the Latvian tax authority's initial thinking. The mere fact of being a nonprofit or only doing commercial activities on an ancillary basis does not stop an organization from carrying out an economic activity for VAT purposes. The Latvian tax authority, it seems, misinterpreted this key provision. They put maybe too much weight on the nonprofit label itself.
And it goes further. Even substantial public subsidies, often the lifeblood of these organizations, don't change the economic or non-economic nature of the activity itself. To figure out if an activity is economic, the court advised looking case by case and asking, does the nonprofit's conduct look like that of a typical active entrepreneur in that same field? Think of it this way. If a charity runs a soup kitchen, that's its core mission. Fine. But if it also runs a cafe next door to fund that soup kitchen, the cafe operation itself, buying coffee beans, selling lattes, paying baristas, that looks like an economic activity, even if every single penny goes to the good cause. The ECJ is saying we look at the cafe operation objectively, not just the ultimate soup kitchen purpose.
Okay, so applying that logic to the Latvian Association's case. When looking at their conduct through that typical entrepreneur lens, the answer was pretty much a yes. They actively sought projects, clients, instructors. They acquired services via subcontracting. They had recipients pay part of the cost. They assessed knowledge levels, gathered feedback. They even had their own staff doing this. From an outside perspective, the association really did appear to be a provider of training services, comparable to any other commercial operator in the market, competing with them in effect.
Exactly. Even if its business plan aimed only for financial equilibrium, not profit, its actual activities mirrored those of a commercial entity. Therefore, the ECJ concluded that yes, a nonprofit organization like the Latvian ICT Association must be regarded as a taxable person carrying out an economic activity, provided its actions are comparable to those of a typical economic operator in that sector.
Now, there was an important caveat from the ECJ, wasn't there?
Yes, very important. The ECJ noted that the National Court in Latvia still needs to verify if the specific training services fall under a potential exemption. There's an exemption for certain types of vocational training outlined in Article 132.1 Directive. That specific question wasn't formally put to the ECJ in this preliminary ruling. So the final determination on taxability for this specific type of training is still technically up to the Latvian courts. But the overall principles about who is a taxable person, what counts as a service for consideration, and how subsidies factor in those are now crystal clear thanks to this ruling.
Right. So this deep dive into the Latvian ICT Association case, it reveals a truly pivotal principle in EU VAT law. Your legal status as a nonprofit doesn't automatically grant you an exemption from VAT obligations. It just doesn't. What ultimately matters is the nature of your activities. Do they objectively meet the criteria of economic activity and supply of services for consideration?
hmm This is a really significant clarification for countless nonprofits right across Europe. The court's ruling really emphasizes that the how you operate is often more important than the why you operate, at least when it comes to VAT.
Okay, so let's boil it down. What are the key takeaways for you listening to remember from this ruling? First, nonprofit doesn't automatically mean non-taxable. If your nonprofit activities objectively look like those of a commercial operator, you are likely considered a taxable person for VAT. Simple as that. Second, subcontracting isn't a loophole.
Mhm.
Using subcontractors doesn't change your status as the main service provider if you're acting in your own name as the organizer. And third, grants can be taxable. Subsidies directly linked to the price of a specific service you provide count towards your taxable amount.
Yeah, this really encourages or maybe forces some critical thinking about how nonprofits structure their operations and their funding models. It's a pretty stark reminder that even when your ultimate goal is purely social good, the means by which you achieve it can have significant and sometimes unexpected tax implications.
So, what does this all mean for you? Well, for nonprofits relying heavily on public funding, this ruling really underscores the urgent need for meticulous financial planning and VAT compliance, right from the very outset of any project. It fundamentally blurs those traditional lines, forcing organizations to ask themselves, okay, are we truly acting purely for social good here? Or are our methods and operations actually putting us squarely in the commercial sphere, even if our ultimate goal isn't profit? How might this objective assessment reshape the way nonprofits structure their projects and funding models in the future? Will it prompt them to restructure operations, or maybe just ensure they budget properly for VAT? This ruling is a potent reminder, isn't it, that even the most altruistic endeavors must navigate the complexities of tax law with their eyes wide open.